You've worked hard, you've done your duty, saved your pennies, and now it's time to think about retirement. But before you let loose, you may have critical questions. How can I pick the best plan for me? Where do I go for the right information? What are the tools to make my money grow? Strategy, information, solutions, and advice from qualified credentialed professionals. Joe Anderson and Al Clopine of Pure Financial Advisors have the answers to your retirement plan. This is Your Money, Your Wealth.
It's a little bit after the hour. Good morning once again. Joe Anderson here. I'm a certified financial planner. As always, right next to the big man, Big Al Clopine. He's sitting right over there. Got a great show lined up over the next half an hour. Show you're watching is called Your Money, Your Wealth. Every Saturday from 11 to 11:30, we're going to try to cram in a bunch of really good nuggets. A lot of good information over the next half an hour to help you succeed in your overall retirement. Let me ask you this. Let me start the show off with this question. What do you think your biggest expense is going to be once you hit retirement? If you're not in retirement, here's the answers that we usually hear. It's probably going to be my housing, mortgage, maybe insurances, maybe health care, travel, leisure. Yes, that's what most people think before they hit retirement. It's funny, Lincoln Financial did a study over the last couple of weeks, and they surveyed a bunch of retirees. And they asked them, what is the biggest expense that you have? Almost 40% of people that were surveyed said taxes was their number one expense. Taxes. But most people don't think about taxes once they hit retirement. So what people are doing is they're trying to control the things that they can't control, such as the stock market, such as interest rates. They can't control that. But one of the things that you can control is taxes. So that's what's on my mind today. All right, money on my mind. Here's what we're going to get into. I want to talk about things that you can control. You don't want to control the things that you can't control, but if you can control the things you can control, you're going to have better success in your overall financial life. So one of the things that you can control is the risk that you're taking on in your overall investments. Number two is the fees that you're paying in your overall investment. So you can control the risk, how much money that you have in stocks and bonds. You can control the fees, that's what type of investments that you're choosing. And then I think the most important thing of all is taxes. You can control the taxes if you do the appropriate planning. Here's the tough part about this. The IRS doesn't tell you what you can do. It'd be ideal if there was a roadmap. If you just open up a code, it said, here's my age, here's my assets, here's my goals, and then you point and click, and boom, there came out a plan. No, the IRS doesn't tell you what you can do. It tells you what you cannot do. So it's up to you to interpret the IRS code as best as you can to your specific situation to do the appropriate planning. To help figure all this stuff out, let's bring on my partner, Big Al Clopine. Welcome, buddy.
Well, thank you, Joe. And you're right. A lot of people try to control what they cannot control. And I'll tell you, taxes is one of these things that you really do have a measure of control. And what I mean by that is there's ways to create tax-free income, which we will talk about on this show. But before we get there, let's start talking about risk, because everyone wants to time the stock market timing. And the truth is, you just can't do that very well, even though we try to. You have no control over it. And really what you want to do is think about what people like Warren Buffett say, which is, I don't really care what the market's doing in a day or a week or a month. I care what it's doing 10 years from now, because markets go up over the long term. But over the short term, Joe, anything is possible.
Yeah, if you take a look at the investment strategy that most people do, it's kind of a gut feeling. Right. They invest with emotion. They invest with, the cookie cutter mentality, or maybe the water cooler mentality.
Right.
See, what is my neighbor doing? He's a very sharp person, so let's see what investments that they're in. And then if you look at the wrong things that people do, they get in and out of the market at the wrong time. They listen to the hype. They try to beat the overall market with whatever information that they can find. But the only way to truly beat the market is to have information that no one else has.
Yeah, and that's insider trading, and that's actually not really legal.
No, that's a totally different retirement, right? If you want to use that strategy, right, you can have a nice retirement. You get 3 square meals a day, right? You get some shelter, but it's called prison. It's called prison. So when you look at emotions, people get very excited when the market's up. It's like, wow, look at markets are at all-time highs. Let me get back in. Let's make a bunch of money. And then when the market goes down, that's when people get, oh boy, deflated a little bit. It's like, but that's the greatest opportunity for return when markets are down, not necessarily when they're high. So you need to be purchasing stocks when markets are low and then selling when they're high. But it's very difficult to time all this. That's why you need a specific strategy for your overall goals and timeframes.
Right, and it's easier said than done, because really when you try to time the market, you'll almost always make the wrong decision. Almost a guarantee is if you think it's time to get in the market and you put all your assets in the market, sure enough, it's probably going to go down. And we see that time after time. And what happens is people really, when they do that, then they end up thinking, well, the market is not for me because I got in and it didn't work. And really, there's got to be a better way. And it really has to do with how much risk you should be taking. And factors that affect your risk tolerance would be things like your personality, how much can you handle, your time horizon, your future earning capacity, financial circumstances, for example. All these affect really how much you should have in stocks and bonds, and it's really different for everybody.
Right, and it's based on your overall circumstance. And so how do you buy high, or buy low, sell high, is that you have to have the current strategy in place now, and then make sure that you reallocate. So you don't necessarily want to continue to ride stocks. So if I have a 60-40 split per se, 60% stocks, 40% bonds, and then over the last 5 years when the market had this big run, and then now I might have 70% in stocks and 30% in bonds. Well, now I'm taking on too much risk. So I want to tone that down. I want to sell my stocks to get it back to the appropriate allocation. But people listen to the noise. People get all excited about what's going on in the overall marketplace. What's buy this, sell here, let's get in, let's get out. You know, there's a great movie called Trading Places, and there's a great clip that I want to show right now. So Ty, if you can roll that, let's see what not to do in the overall markets.
Take him. 209. Yeah, got him. 139. 140. Hey, to me, Minneapolis.
Now.
Yeah. South Northern April at 142. That's not right.
You know, it's funny looking at that movie because the market floor doesn't really act that way anymore. It's all based on computers. But just to kind of give you an idea of what that movie's all about, if you haven't seen it, it's a phenomenal movie. I highly recommend it. Is that right there, they're trading orange juice, frozen concentrated orange juice. And then Eddie Murphy and Dan Aykroyd had the inside scoop. They had the crop report on the orange juice. So they had the insider information. And the Duke brothers, you saw in the big booth there, they thought the stock price was going to go a different direction. So they had the information that no one else has, and that's how they profit extremely well off that. And the other side of the coin, they lost big. When you look at the stock market, it's a zero-sum game. If there's a winner, there's a loser. If I'm buying a stock, I'm buying it from someone else. My anticipation is that stock price is going to go up. The other person on the side of the trade thinks the stock price is going to go where? Either flat or go down. My question to you is who's on the other side of the trade? You have to be extremely careful if you're trying to bet in the overall markets, especially if you're in retirement. Take a look at this here, Al. If I lose 30% in the overall stock market, okay, if I lose 30%, that's very easy. We've seen 50% drops in the last several years. So let's say I lose 30% of my portfolio. I need a 43% rate of return just to get my money back. 43%. If I'm taking money out of that portfolio in a retirement income strategy, it's going to be very difficult for me to get to get caught up. So when you look at a portfolio in overall retirement, when we're looking at the things that you can control, and risk is one of the number one factors that you can, is that, well, how much risk should you be taking? And most people, there's two sides of the coin. You might be taking on too much risk. If I'm approaching retirement, you can't afford to have a 20, 30, 40, 50% drop. If the market drops 50% again, you need a 100% rate of return just to get your money back. On the flip side of that, Al, people are not taking enough risk.
Boy, we see that all the time too, Joe. And here's an example of somebody that starts retirement with $500,000. And let's assume that you're withdrawing about 4% of the portfolio per year. So that would be about $20,000 per year. And it's indexed for inflation. So what that simply means then is how much money are you going to have based upon certain interest rates, right? So if you're all safe, 100%, so 100% CDs, let's say, Joe, for example, then what's your portfolio going to be after about 20 years? It's actually negative. You're out of money. You're completely out of money. Now, on the other hand, if you invested at about a 6% return, it's actually over $600,000. So you have to have a certain amount of risk in the market. And what we see is that people take either too much or not enough over and over again.
Right, and then they're not managing their assets toward their particular goals. You have to find out, first of all, do some analysis and say, all right, well, how much money do I need to derive from the overall portfolio? In our opinion, we're a very conservative firm, and we say that you should not take on any more risk than you absolutely need to provide the goal in mind. So if I'm looking at maintaining a $50,000 lifestyle, $100,000, $200,000, whatever it is, do some planning up front, and then you can find out what that portfolio should look like. So taking on too much risk is a huge component of that, but not taking enough risk, because what we talked about before is that, well, people are living 20, 30, 40 years in retirement. So if everything's sitting in cash, I'm losing money safely, right? There's risk in every single investment. Another big component that you want to make sure that you control is fees. I would say most individuals, most of you out there have no idea how much that you're paying in fees. Here's a quick example. Now, this is just totally hypothetical. This is not indication of future performance and all of the compliance things that's involved here. But let's say that if I have an 8% total return in the overall market, but I'm paying 1.5 points in fees, so my true return is 6.5. I mean, the difference on this, I use pretty big numbers, $1 million over 30 years, given that differential. It's huge. It's several $1 million differential. So you want to make sure, all right, how can I control the fees? Well, first of all, you want to take a look at the investments that you're in. Most people that we see are in very high investments. They look at retail mutual funds. Those are extremely high in cost. If you look at the average expense ratio, maybe it could be 1 point, 1.5 points, and then you got the trading cost of those retail mutual fund managers buying and selling the particular stocks.
Yeah, you're not kidding. And retail mutual funds are really what most people tend to invest in, which basically means you're paying very high costs. And Morningstar actually did a study, and they came out with about a 1.3% cost. That's before turnover. Turnover simply means that they're buying and selling stocks, within your portfolio, which is causing additional cost. And 100% turnover adds about another percent or so. So you're getting over 2% on a lot of these retail mutual funds.
Right, and then if you look into the 401k plans, people have no idea. There's very little transparency in what's going on. Then you also look at another popular product out there that is getting sold by the big brokerage firms are variable annuities. Because after 2000 through 2010, we call it the lost decade, a lot of people lost a lot of money. If you remember, from 2000 through 2002, we had the dot-com bust. And then you look, all right, well, here, just a few short years later, we had the Great Recession. So over that 10-year time period, people lost a lot of money. So then the insurance companies come out and the big brokerage firms come out with different types of products, such as guarantees. You have to be very careful with these particular products, because the internal cost and fees and administration cost, it could be as high as up for anywhere from 3 to 4 to 5%, really depending on the overall product. And then you have separate managed accounts. The list goes on and on of all the different things that the brokerage firms are trying to sell you that at very high cost, that is really profitable for Wall Street, but it's really taking a lot of money out of yours. We got to take a break. When we get back, I want to give you a solution here. So those are the problems. Those are high fees. Let's get into low fees. What are some things that you can take a look at? Big Al wants to get into taxes. I can't shut him up about taxes. That's all he wants to talk about. The guy's been a CPA for 30 some odd years. So when we get back, we'll talk about taxes, some tax planning strategies that you want to take a look at. We'll talk real estate. There's so much more to go, so don't go anywhere. The show's called Your Money, Your Wealth, but I want to get a true-false question coming up right now. Welcome back to the show, folks. Show's called Your Money, and it's Your Wealth. My name's Joe Anderson, certified financial planner. With, as always, Big Al Clopine. Thanks for tuning in this Saturday, 11:30, right here on Channel 4. Lot of things to discuss today. We're looking at things that you can't control. A lot of you want to control things that you absolutely can't, such as the markets. You're trying to time the markets, get in and out. A lot of confusion out there. The media is just filling you with information that you probably should just ignore. We want to focus on the things that you can control. So before the break, we talked about a couple of different things. We're looking at, all right, well, can I control the risk? How much risk that I'm taking on in the overall portfolio? The answer is absolutely yes. We're also looked at fees. How much fees are you paying in the overall portfolio? We looked at high fee investments. I'm going to get to low fee investments in just a second. But what I want to do is answer that true false question, because I'm sure most of you that saw that question are very confused. So here's the question. The best time for me to invest in California municipal bonds is when I'm subject to high tax rates. Let's see. Do you think that answer, Al, is true or false? And I'm guessing that is the dinner bell.
That sounds true. That sounds like that's true.
That's not a buzzer.
Yeah, that's got to be a good thing.
Yes, that is a very good thing. So yes, the answer is true when you invest in California municipal bonds, and we're going to get into that in just a second. We went a little bit late, so what I want to do is I want to get back to investments and what type of investments that you should look into, and then we're going to talk about taxes, because municipal bonds is a really key component in someone's overall investment strategy when it comes to retirement income. And then when you look at a retirement income strategy, if I can reduce the taxes that I pay on the income, I can reduce my risk substantially. And if I'm in retirement, risk is the most important component that you want to look for. So we looked at discipline when it comes to your investment strategy of, all right, stocks versus bonds, how much risk that you should be taking. Then we looked at fees, high fee investments. We looked at retail mutual fund, variable annuities, separate managed accounts. Now let's get into low fee investments, because fees are a huge drag on the overall performance. So if I'm looking at a low fee investments, I want to look at index funds, exchange traded funds, or maybe an institutional type mutual fund that's passively managed. There's very little turnover here. So if I look at a comparison, if a retail mutual fund like Al, you were talking about, was maybe, 1.5%, 2% in some cases?
Exactly, yes.
Where an index fund or an exchange traded fund is going to cost you maybe 0.1%, 0.2%, maybe a 90% savings on your overall cost. And the problem with these high fees is that portfolio manager or your broker or whoever's managing your money has to get a higher rate of return than that fee. So if your internal fees are 2%, then they're charging you another 1.5%. You're 3.5%, 4% in. That investment has to beat the overall index or their benchmark by that measure just for you to profit even anymore. So it doesn't make a lot of sense. Control the things that you can't control, and we're a big believer that if you mitigate your fees, if you mitigate your risk, you're going to be better off. But the most important component of the topic today is taxes. So what do you think is the best tax rate that you can possibly pay?
I would say 0.
Well, there is no better rate than 0, is there?
I think that's a great rate.
So when you're looking at investing, I want to make sure that I can... Oh, yes.
Hallelujah.
Hallelujah.
I'm back in church.
Yes, tax-free.
Tax-free?
Right, yes.
What's better than that?
The gospel of today is tax-free income. So when you look at things that you can control, taxes are a big component. But now, there's two terms here when we're looking at tax planning. Big Al's been in the business for some odd 30 years. There is something that's called tax avoidance, and then there is also something that is called tax evasion. All right? So what we want to talk about or focus in on is tax avoidance, because tax evasion is going to put you where?
Yeah, that puts you right in jail. You don't want to evade. You want to follow the laws.
They sound similar.
They do sound very similar. Avoidance is fine. It's completely acceptable to avoid taxes legally. And the tax code is roughly 16 feet high if you stack it up from bottom to top. And then there's revenue rulings and other kinds of pronouncements, private letter rulings, and so on. You could fill an entire library with tax law, but there's a lot there for you that you can reduce your taxes, and a lot that you can do legally. As far as evasion, though, that's when you're not following the laws, and you can go to jail on that one.
Well, you know, a famous actor went to jail, an action hero in his day. Wesley Snipes went to jail for, even the famous people can go to jail for tax evasion.
He did, and what happened with him was he didn't file his tax returns in in 1999, 2000, 2001. Supposedly he didn't file them later, but that's what he was prosecuted for. He also supposedly filed some amended returns that were false earlier than that, asking for $4 million refund, $7 million refund. You can't do that. And so he went to jail for 3 years.
You can't do that?
Can't do it. Can't do it. It's not allowed.
Yeah, just stick with acting. Pay your taxes. All right. But here's the point. It's your given right to do everything that you can to avoid taxes. You don't necessarily want to evade them. You want to avoid them. So let's get into some strategy. What we talked about with the true-false question was municipal bonds. So municipal bonds is a great way to create tax-free income. And why don't you hit on that, Al?
Yeah, with muni bonds, first of all, it's 100% tax-free, and that's a huge benefit. And that's one thing we're going to talk about. We're also going to talk about Roth IRAs, because that truly is a way to get tax-free income out of your retirement dollars. And then your capital gains coming from your non-retirement assets, which are really your stocks and bonds, real estate outside of retirement. There's a 15% capital gain rate, but if you're in a low enough tax bracket, your tax rate is 0, plus you can tax loss harvest, which means you actually sell other assets at a loss and net those against the assets at a gain dollar for dollar. So you can actually end up paying no tax on your capital gains as well.
So let's start with municipal bonds.
All right.
So if I invest in a California municipal bond, it's triple tax-free, state, local, federal, unless they're from Stockton, which some of those defaulted.
Yeah, you don't want to do that.
You don't want to do that.
Or Detroit.
Yes, you want to take a look a little bit under the hood, if you will, of what that bond is doing, because what a bond is just a loan. You're lending your money out to that municipality. They're using that capital for different projects for different reasons. There's general obligation bonds. There's revenue bonds. Be careful here. You want to look at, okay, well, what is the risk that I'm taking to get the overall return? Second thing, Al, you have to look at your tax bracket, because there's something that's called a tax equivalent yield that's going to tell you what your true rate of return is if I have a tax-free municipal bond.
Well, you do, because if you're not in a high tax bracket, there's really not a lot of benefit, because you're probably going to receive a lower interest rate on a municipal bond. But take a look at this chart. Let's say you're in the 25% tax bracket on the left, and let's follow it all the way to the end. And that means at a 5% rate of return, you're earning about 6.67% in terms of a tax equivalent rate. So that's basically the rate you would be earning on a taxable account. So you want to look at your tax rate to figure out whether the municipal bonds are going to make sense for you. If you're in a low bracket, they probably don't make sense. And the other thing too is make sure that your municipal bonds are in your non-retirement accounts. How many times do we see municipal bonds in retirement accounts? It's completely wasted. That tax-free nature will actually be ordinary income when you do your required distributions later.
Right. Well, because I think they're just looking at, all right, well, here's the yield, here's the maturity, and then they just buy the bonds, and then they find, oh, wait a minute, this is a municipal bond. It's sitting in my retirement account. You're not going to get tax-free treatment from that at all. If it's inside of a shell of a retirement account, everything that comes out of those shells or those retirement accounts is going to come out as ordinary income. If you hold a municipal bond or not, it doesn't matter. Everything that comes out of there is going to be taxed at ordinary income. You also have to be careful here. You have to look under the hood, because there was Meredith Whitney came out a few years back and said that there's going to be several defaults in the municipal markets. And then Detroit, we actually have a clip on some of the things that happen in Detroit when it comes to their overall bonds. I think a lot of people are familiar with what happened to the good old city of Detroit.
Yeah, and we'll hopefully get to that video in a second. But I would tell you, with your bonds, there's revenue bonds, there's general obligation bonds, and you want to look at the credit rating of the municipality. Not all bonds are created equal.
Right, you don't want to look at the rate of return. So let's go to the video.
Detroit defaulted on more than $600 million of general obligation bonds deemed unsecured by the city's emergency manager, a city spokesman said. The move marked the second bond default by cash-strapped Detroit after Kevin Orr, the former corporate bankruptcy attorney who has been running the city since March, announced on June 14th a moratorium on unsecured debt payments.
So safety is very important in your bonds, and clearly with this Detroit situation and other cities like Stockton in California, you ended up losing money because of the credit rating and the bonds defaulted. But the next thing we want to talk about is Roth IRAs. And Roth IRAs is really another way to create tax-free income. And there's a couple ways to get money into Roth. You can do a contribution. If you're working, it's $5,500 per person, $6,500 if you're over 50. Or you can do a conversion from your IRA to the Roth. And the Roth itself is a special kind of retirement account that grows 100% tax-free. And Joe, there's nothing better than tax-free.
Well, Al, here, I'm going to draw these just about every week because I think it brings the point across. Is that I'm going to draw the diagrams here, these lovely circles. If you haven't seen the show, you're going to get familiar with Sesame Street type of financial planning, because I think the simpler you can make it, the more you'll understand and the more you'll implement. And so we were talking about a tax-free pool here. So any dollar that that would come out of this account would be tax-free. So your municipal bonds, Roth IRAs is a good example of these accounts. This would be, let's say, a tax-deferred account where most of your assets are held. These are your retirement accounts, your 401ks, your 403bs, your TSPs. And then we also have a taxable account. So these are just any assets that you hold outside of a retirement account. It could be real estate, it could be mutual funds, stocks, bonds, just any asset that is held outside of retirement. So what we have found is that most of your assets are sitting in these tax-deferred accounts. And when it's come time for you to create the retirement income that you need long-term, is that everything is taxed at the highest of rates. What we're trying to educate you is control the things that you can control. You can control the risk that you're taking on the portfolio. All right? You can control the amount of taxation that is in the overall portfolio. And then, of course, you can control your fees. So if I have more dollars in a tax-free component, that is a good thing. So when we get back from the break, I want to touch on a couple of different things here when it comes to tax-free income. We'll get into the brackets to show you, all right, well, how do you start pulling money from these accounts? Which ones do you pull from first, or do you do a combination of all three, or do you let these grow forever? A lot of confusion here. I want to break the myths when we get back. We got another question, true or false, coming up right now, so don't go anywhere. Show's called Your Money and It's Your Wealth. Right here, real estate rental income can provide a tax-free source of income. That was the true-false question before we went to the break. And the answer, of course, to that, Al, is what?
It's true, of course.
It's true.
And there's the bill.
There's the bell.
We know it.
We're going to talk a lot more about real estate later on in future shows, so don't go anywhere from that. So here, when we left the break, we talked about there's assets that you can hold in different areas, and they're all taxed differently, and most people get confused on which one should you pull from first. How do you come up with the retirement income strategy? That's what we're going to talk about next week, so stick around. Don't go anywhere. Show's called Your Money, Your Wealth. We're going to look at Roth IRA conversions. We're going to talk about Roth IRA contributions, how to pull the money out, when should you pull it, how to mitigate your taxes to save you tens, if not hundreds of thousands of dollars long term. We're excited, Al. Great show today for Big Al Clopine. My name's Joe Anderson. Stick around next week, 11 to 11:30, right here, same station. Show's called Your Money, Your Wealth. Have a great weekend, everyone.